Welcome to a new episode of our program. I've got good news and bad news for you. The bad news is your money is losing value. Well, my friend, even if you save up money, you'll still lose some of it over time. In economics, there's something called inflation. When countries get into trouble, they print more money. And when money becomes more abundant, its value decreases. We've seen this many times throughout history. One of the most famous examples was the German hyperinflation. But history doesn't only give us old examples, like Hungary, where prices used to double every 15 hours with a daily inflation rate of 200%. Not only that, monthly inflation reached 4.19 times 10 to the 16th percent. That's a massive number. If you don't understand what that means, it wasn't strange at all to see Hungarian banknotes thrown on the ground because they had become worthless. In countries like these, people would carry money in shovels, and kids literally played with cash like toys because it had no value. And like I said, this wasn't just in the past. In 2019, we saw a country like Venezuela where inflation reached 65,000%. And this is happening today, even though we now have economists, sociologists, and historians. Someone might say, okay, those are small countries. I'm smart. I save my money in US dollars, the strongest currency in the world. Well, let me tell you, in January 2020 alone, the United States printed the equivalent of 40% of all dollars in existence. In just the last 2 years, the Federal Reserve printed around 80% of the dollars currently circulating in the economy. That's brand new money flooding the world. This huge increase in money supply caused inflation rates to rise to nearly 8%. That means prices became 8% more expensive. So even if your savings are in dollars, you still became 8% poorer while your money just sat there doing nothing. And that's the dollar, supposedly the most stable currency.
What I'm trying to tell you from all these numbers is simple. If your money is just sitting there, you are losing. But I said there was good news. Yes, there is. I have the solution. Investing. Money can make more money. And I'm going to talk about ways to invest that are cheap, fast, safe, and easy. I'll show you that if you do this, not only will you protect your money from inflation, but you can also make money while sitting at home. Listen to me until the end, and I promise you'll benefit and hopefully achieve financial independence, where you can sit at home doing whatever you want, writing, making poetry, traveling, enjoying time with your friends and family. The first lesson I want to teach you is this. Rich people are not the ones who work hard and earn a high salary. Rich people are those who make money while sleeping at home. And I'll explain why. Let's talk about the stock market. What is the stock market? It's basically a marketplace of companies where you can own a small part of economic giants. If you have around $60 or $100, you can become a partner in Apple. Yes, my friend, your ownership percentage will be tiny, but technically, you are still an investor in Apple. You earn profits when the company makes money, and your share grows as the company grows.
For example, over the last 5 years, Apple stock rose more than 360%. So if you had invested $10,000, you'd now have around $36,000. Tesla? If you had invested 10,000 pounds in Tesla 5 years ago, today it would be worth around 150,000 pounds, over 1,500% growth. In the stock market, my friend, you can make huge profits. Wow, my friend, I'm amazed. I'm going to sell my laptop and gold and invest everything in the stock market. Relax. If it were that easy, nobody would lose. Because the stock market can also destroy you. For example, Amazon, Jeff Bezos' legendary company, If you bought Amazon shares in 1999 at $113, by 2001, the stock had dropped to only $5. Imagine putting all your money there. You would have lost 90% of your wealth. Of course, over the last 25 years, Amazon eventually grew massively. But the point is, the stock market is not easy. Just as you can win big, you can also lose big if you don't study properly. So, should I invest in the stock market or not? Here comes the magic word: ETFs, exchange traded funds. Remember this term because it's the key to everything in this episode. An ETF is basically a basket containing shares of many companies. Instead of buying one company, you buy a collection. For example, there's a famous ETF called VOO, which contains shares of the top 500 companies in America. So instead of gambling all your money on one company that might succeed or fail, you spread your risk across 500 companies. And not just any companies, the biggest and strongest companies in America. This protects you from the chaos of the world.
Now listen carefully. The average return from investing in those 500 companies has historically been around 10% per year. Someone says, is that guaranteed? No, nothing is guaranteed. But this 10% is the average over the last 100 years. For an entire century, the stock market has averaged around 10% annual growth. Someone might say, the stock market is terrifying. What if there's a financial crisis? And honestly, you'd be right. But we need to understand the difference between speculation and investing. Speculation means buying a stock today, hoping it rises tomorrow so you can quickly sell it. That's gambling. Real investing is long-term, at least 10 years. Let me give you an example. If you invested in 2007 in VOO, the ETF with the top 500 companies, everything looked great. Then, boom, the 2008 financial crisis hit and the value dropped massively by 2009. You'd watch your wealth getting cut in half. You panic, curse, and regret everything. But remember, investing is long-term. The market always goes through cycles. Crashes are normal. The stock market goes up and down, but over the long run, the overall direction has historically been upward.
Those 1,000 pounds you invested in 2007, after surviving one of the worst global financial crises ever, would today be worth around 4,400 pounds, more than 200% growth. That's why when you invest, you should think in terms of 15 to 20 years. This is extremely important because when there's a crisis, a pandemic, or a war, you shouldn't panic and withdraw your money. In fact, that's often the best time to buy more. And this isn't just my opinion. Peter Lynch, one of the greatest investors in history, used to say that economic crises are basically the Black Friday sales of the stock market. Buy when prices crash. Warren Buffett, arguably the greatest investor of all time, joked that the stock market is the only place where people run away when things go on sale. Think about it. If Carrefour discounts cheese by 50%, people rush to buy it. But when Microsoft or Amazon stock drops 50%, people panic and run away.
This strategy is often called buy the dip, and many great investors recommend buying consistently every month, regardless of prices, a strategy called dollar cost averaging. Studies show it's better emotionally and financially than dumping all your money at once. Because if you invest everything and then see your portfolio crash, emotions will destroy you and you'll sell at a loss. One platform once calculated that if you saved 1,000 pounds every month for 20 years, you'd end up with 240,000 pounds under your mattress. Sounds nice, right? But if you invested it instead, the numbers become dramatically larger. The point is, consistency matters. Then comes the beauty of compound interest. Let's say you invest 1,000 pounds and earn 10% annually. First year, you make 100 pounds. Now you have 1,100.
Next year, your 10% becomes 110 pounds, then 121 pounds. The number keeps growing faster and faster until one day your investments might make more money than your salary while you sit at home.
And sadly, nobody teaches us this in school. They teach us where rivers flow, but not how to build wealth, invest, start businesses, marry, raise children, or retire properly. Now, someone asks, but banks give guaranteed 14% returns. Isn't that better? Excellent question. And this brings us to the most important rule in investing: diversification. Never put all your eggs in one basket unless you truly know what you're doing. Spread your money across stocks, gold, real estate, bonds, maybe even collectibles. There are ETFs for everything now. Real estate ETFs, gold ETFs, bond ETFs, energy ETFs. You can invest in real estate without buying an apartment. You can invest in gold without hiding gold bars in your house. Everything has become easier, cheaper, and more accessible. Some people say, why not just let professionals invest for me? Sounds logical, but studies show that most professional fund managers actually perform worse than the S&P 500 over long periods. Warren Buffett even famously bet hedge funds that a simple S&P 500 ETF would outperform them over 10 years, and he won.
So, the key lesson is this: investing isn't magic, it's patience, discipline, diversification, and long-term thinking. At the end of the day, there's a huge difference between speculation and investing. Speculation is dangerous if you don't understand what you're doing. Investing still has risks, but it's far safer than most people imagine, especially with ETFs. There are ETFs for the top 500 companies, the top 1,000 companies, global stocks, gold, silver, government bonds, company bonds, energy sectors, and almost everything else imaginable. If you're not an expert, diversify. Build a portfolio that suits your personality and goals. And the beautiful thing about modern investing apps is that you can even practice with demo accounts before risking real money.
One last important thing. I'm simply sharing information and repeating the wisdom of some of the greatest investors in history, like Warren Buffett, Ray Dalio, and Peter Lynch. So use your brain, study carefully, and think long term. And finally, if you enjoyed this episode, check out the previous ones, watch the upcoming episodes, and subscribe to the channel.